Welcome to the BuyBox Experts podcast. We bring to light the unique opportunities brands face in today's e-commerce world.
Hi, this is James Thompson from the BuyBox Experts podcast. Today's episode is part of a special series of interviews that we have done to dive deeper into the recent phenomenon of private equity companies and FBA aggregators investing in private label brands that are leveraging the Amazon sales channel. As part of this series, we interview a wide range of investors, brokers, consultants, and entrepreneurs that have recently sold their private label brands. We peel back the layers on what's happening in this new investment space and look at how private label brands are finding financial success through the building and eventual sale of their online businesses. For 3 weeks, from mid-February through early March, we will release a new episode every weekday on this topic. Sit back and enjoy today's episode. Hi, I'm James Thompson, one of the hosts of the BuyBox Experts podcast. I'm a partner with BuyBox Experts and the former business head of the Selling on Amazon team, as well as the first account manager for the Fulfillment by Amazon program. I'm also co-author of a couple of books on Amazon, including the recent book, Controlling Your Brand in the Age of Amazon. Today's episode is brought to you by BuyBox Experts. BuyBox Experts takes ambitious brands and makes them unbeatable. When you hire BuyBox Experts, you receive the strategy optimization and marketing performance to succeed on Amazon. We also support investors with due diligence services. Go to buyboxexperts.com to learn more. Before I introduce our guest today, I'd like to send a big shout out to the team at Disruptive Advertising. For off-Amazon advertising, Disruptive Advertising offers the highest level of service in the digital marketing industry. Focusing on driving traffic, converting traffic, and enterprise analytics, Disruptive helps their clients increase their bottom line month after month. Check out disruptiveadvertising.com to learn more. Our guest today is Richard Jalichandra, an investment banker specializing in selling and financing Amazon businesses, as well as a consultant for multiple institutional investors investing in Amazon businesses. Between 2017 and 2019, Richard was the founder and CEO of 101 Commerce, a firm that publicly announced that it would acquire 101 FBA brands. While Richard and his team didn't end up acquiring a full 101 firms, he continues to advise Amazon investors and FBA sellers today. His perspective on how investors can build portfolios of FBA brands is why I am so pleased to have Richard joining us today. Richard, welcome and thank you for joining us today on the BuyBox Experts podcast.
Thank you, James. It's great to be here.
In 2017, when 101 Commerce started looking at brands, you evaluated hundreds of brands a quarter. But today, the deal flow for FBA businesses is much larger, as FBA private label businesses are finally a hot commodity. In your view, what happened to generate this recent interest in such businesses that have been around since the beginning of the Amazon marketplace?
You know, there's a couple of ways I can answer that, but I think it's actually good if we kind of go back in time. And frankly, given your experience, you actually may want to chime in on some of this. But as somebody who is kind of an outsider, I think I've known about FBA since probably it started 2005, 2006, somewhere in there. But something seemed to happen with Amazon around 2014, which is kind of when the great golden age of FBA seemed to explode. And I think, you know, the way and you may know this, chime in, I'd love to hear it, but something seemed to happen inside of Amazon where I think they probably looked at their AWS business and saw how successful that was, and then looked at these other three letters and said, well, wait a second, FBA could literally be, you know, AWS for retail. And let's throw gasoline on that. And if you look at kind of like the percentage of GMV that was generated by first party versus third party, it's around 2014, 2015 that it just takes off. And then, you know, simultaneously outside of the company, you've got this macro trend of digital solopreneurs and, you know, wandering around the world trying to make money and figuring out side hustles. And they're starting to launch their own, you know, private label brands and things. And it just exploded. And the crazy thing for me was, and I've told this story in a few places, but I'll tell it again in a little more detail. But, you know, in 2016, I was running a $500 million e-commerce business, bodybuilding.com. We sold vitamins and supplements. And, you know, I was kind of brought in there to kind of save it and turn it around. And I was looking at the data, and of course, it was really obvious that it was Amazon was creating the cracks in the foundation.
Yep.
But the first thing that I thought was that it was literally our wholesale partners that were just migrating over to Amazon. And yes, of course, they were starting to sell more on Amazon, but that wasn't the tidal wave that was developing. The tidal wave was all these mom and pop sellers that nobody had ever heard of, selling vitamins and supplements and protein powder, where it was death by 1,000 paper cuts.
Right.
That's kind of when I like started going, wait a second, this is really an interesting phenomenon. Ultimately, I didn't think that the company could be, turned around, and we parted ways and all that. But I became obsessed with like researching FBA sellers. And the other thing that I noticed was, if the golden age started in 2014, 2015, there was almost no secondary market for selling these things.
Right.
2016. And then all of a sudden, I think there's a friend of mine in the ecosystem that tracks the sales of these things. All of a sudden in 2017, 274 FBA businesses were known to be sold. So you go from 0 to 274, and all of a sudden the light bulb is going off in my head.
Right.
And I start talking to these people, and I started joining some of these communities of solopreneurs and just talking to people. I ended up in 2017 probably talking to 700 sellers, and I did hundreds of hours of research, probably 1,000 hours of research, and I just was enamored. I was actually trying to retire at the time, but I was enamored with all these people running $1 million businesses that were netting 25-30% earnings, and I was like, wait a second, if you bought 100 $1 million businesses that had a 30% net, you'd have the most profitable e-commerce company ever known to man.
Yeah.
And that was the genesis of course, we had to add one and make it catchy. So it was 101 and 101 commerce. And that was the thesis. But that was kind of my take on like how this thing exploded. And now that same friend who tracks, the sales of these things stopped tracking them because he can't count them anymore.
So what do you think is going to happen in the next couple of years as more money flows into this space? Some of these investors know what they're doing, some don't, and there's an awful lot of in between. How do you see both the market for potential sales developing, as well as people jumping into the business of becoming third-party private label sellers because they think there might be an interesting exit?
Let's go backwards 2 or 3 years again and talk about kind of the awareness. The first time I went and talked to an investor about, trying to buy FBA businesses, they looked at me like I'm crazy and like, what are you talking about? And what is FBA and all this?
Yeah.
Certainly we made a little splash. And as I like to say, we were in early and we were out early. As you see in many technology markets, usually the first entry usually doesn't do well. It's usually the second or third. And of course, Thrashio is probably the one that's created the biggest waves. And we can talk all about Thrashio, here as well. But that all of a sudden now, like, I went from 2017 having to explain what FBA is and literally having to take 2 hours to explain to an institutional investor what FBA is, to now, your phone's ringing off the hook, my phone's ringing off the hook. I probably, talked to 50 or 60 different hedge funds, VCs, private equity funds last year. And again, the phone continues, everybody's interested in it now because now there's an awareness. The other thing about the ecosystem that most institutional investors I talked to 3 years ago had a problem getting their arms around how big the whole ecosystem is. You've probably gotten this question a bunch of times in some of the diligence calls you do. It's like, everybody like looks at Thrashio and like, is it already done? They're running away with it. I'm like,
yeah.
My pat answer is there's room for 50 Thrashios. That's how big the ecosystem is.
Yeah. Yeah.
So, that's a long-winded way of kind of like telling you that, and we can get into more of it, but this is far from over.
So you start learning about Amazon sellers, you start talking to them a couple of years back. What were some of the things that you learned about the entrepreneurs themselves that surprised you the most? This is not the same kind of an entrepreneur that you probably have run into outside of Amazon.
Well, we should break it into the entrepreneurs that I met in 2017, that were doing it, and then the ones that you see doing it now. This is a very different cohort background, but you meet an interesting cast of characters in 2017, and I swear to God, I heard this story at least 100 times. It went something approximately like this. It was like, I was working in Cubeville. My life looked like office space. I made $42,000 a year, and I was trying to find a side hustle where I could make like another 10K a year. And so I tried FBA. And the next thing I know, 6 months later, I'm doing $100,000 of sales. And a year later, I quit my job, say F you to the man, and I'm out of here.
Yeah.
And next thing you know, I'm a multimillionaire. Now, that's the ones that had escape velocity, but you kept meeting these people that were doing this. Mm-hmm. And then of course you were meeting these people who were digital nomads too. Like, oh, I'm running a $5 million business out of Chiang Mai, Thailand.
Sure.
Or, I haven't slept in the same, place for more than a week in the last 3 years, because I've just been traveling around the world and running this business. And there's a little bit of, the dream of the 4-hour work week in some of these early pioneers that you would meet. A lot of them, that was their big motivation, was to have a location independent lifestyle. And then next thing you know, they're running, a legitimate business. The one thing I want to point out, though, is like you started seeing people who, there's a certain cohort that runs a $300,000 business. There's a certain cohort and skill level and experience that can run a $500,000, and then $1 million, and then $5 million, and then a $10 million. And one thing I kept seeing with the people who ran $1 million plus businesses was they kind of like, they talked like financial traders. They were kind of quants. Everybody who got into millions of dollars of sales, you realize that they were all good at math. And really good at just intuitively kind of having a sense of like, this is a good trade, this is a bad trade. Yeah. So I saw a lot of analogs to financial traders and what I call the super ninjas, people who could get over $2 million in sales.
And yet some of those same companies have problems doing basic accounting of their businesses.
Absolutely. I can't tell you how many that couldn't forecast their inventory. Or I can't even tell you how many $3 million businesses I met that were basically insolvent because they didn't manage their working capital. Mm-hmm, mm-hmm. But at the same time, you would meet these, unbelievable entrepreneurs who you're just like, wait. One of the first super businesses I met, this is like in 2017, was a couple running a $37 million a year top line, $14.5 million bottom line. A couple, husband and wife.
Yeah.
I'm like, where can you find that kind of business outside of?
Yeah.
It's impossible.
So you've got all this enthusiasm, people wanting to live the American dream, start their own business. Amazon FBA looks like a great place to go. There's easy access to manufacturing capability or capacity in all sorts of industries. How do FBA aggregators, how do they leverage that enthusiasm, not necessarily just buying companies, but also potentially getting into that kind of mentality of let's go figure out what to build and what to buy?
Yeah. So everything's changed since we started. It's totally changed. And I think just the FBA ecosystem has changed a lot. And I don't think you can, like 5 years ago or 4 years ago, you could kind of like, I'll go get a trademark and I'll find a manufacturer.
Right.
Get in there and, next thing you know, you're selling $3 million a year. Those days I think are gone. You have to be pretty serious about it now. And the same with the aggregators. When we started with 101, our buying criteria was definitely customized for Amazon. We'd all done a bunch of M&A before, but we had to completely customize that. But I think it was really elementary based on what I know now, whereas some of these aggregators now are using a lot of data science to analyze deals. And this is one of the predictions I made even at the Prosper conference. I think what my last prediction was that I think, the most sophisticated aggregators will start algorithmically targeting new businesses to buy. They won't be, talking to brokers or bankers. They'll literally be finding the hot deals that are up and coming based on algorithmic data science.
We're already seeing some of that where companies that don't realize they're in play get calls from 2 or 3 different investors saying, we want to buy you. And
Yep.
by the way, I'm willing to pay you millions.
Yep.
And by the way, you don't have to stick around for more than 30 days.
Yep.
Oh, okay. I guess we're selling our business. This is great.
Yep.
Not to say that's the right time to sell, but to your point, the data science is already starting to happen. I'm seeing it with some of the firms we've already been talking to. But data science is one of those things where it's a continuum and you can only get more sophisticated. There's millions of sellers out there. There's an awful lot of data to churn through to find the needles in the rough, so to speak. So
and the other thing about the data science, or second part of your question of like, what do you build, or are these aggregators going to build anything? The same data science tells you what to build and launch, what products, where the piece is in the market, or where there's places to optimize that already exist and things like that. So I mean, it's literally the same algorithms that kind of produce the same data. The thing where it's going to be an unfair fight is the amount of data that you have to crunch to come up with those insights at scale is really expensive. So you need, significant working capital to be able to churn the amount of data that Amazon spits out in the cloud.
Yep.
A friend of mine has played a lot with the data, and he basically said that to do the data crunching that he wants to do to be able to execute the vision that I was talking about, it's minimum of like $100,000 a month of cloud computing. Startup can't do that.
No.
Aggregators raise $100 million can afford $100,000 a month to optimize their business, whether it's targeting or building.
So a couple of years ago, you talked about some of these selection criteria that you were using at the time to look at companies. A healthy gross net margin, solid review structure, compelling business narrative. That's what you knew 2-3 years ago. Where are we going now with regards to sophisticated evaluation criteria for companies?
Well, let's talk about those 3 things first. Those are still gross margin, net margin, review structure. Specifically, net margins are important simply because you're in e-commerce, you're always going to have competition. In Amazon, you're going to have way more competition. So your net margin is kind of your margin for error. And so the way we always looked at a business, if it could have a 25 or 30% net margin, we expected competition either from higher ad spend or having to do pricing pressure could take that down by anywhere from 5 to 10 points.
Okay.
On the back end, though, at scale, an aggregator is going to optimize supply chain, inventory management, and all that. So you could probably gain another 5 to 8 points back on completely the supply chain side of the equation. So then you end up with something. Let's say you bought it at a 30% net, and you lose 5 points because of competition. You gain 5 points back. You're still at a 30% thing. If you even have further competition, you're down to 25%. That's still really good net margin. So
then you put an extra $1 million of growth capital into it, and you'll get all the benefits from that too.
Yeah. There's other organic opportunities. So that's net margin. Of course, Amazon review structure is super important, but it used to be, the review moat of having just a boatload of reviews. And as you know, running and optimizing these things, the algorithm isn't that simplistic anymore. There's all about, velocity and the quality of reviews and things like that work in the algorithm where, I've had experience where we launched a product that had 0 reviews and got to page 1 simply because it had the right velocity in the launch cycle. Now that's a rarity, but you can definitely see something, with 30 reviews competing with something like with 3,000 reviews because of the velocity and recency of the reviews. So those are important. But now to get to the real meat of your question, what's important, what we discovered when we bought our first cohort of deals at 101 was we had some blind spots that were largely around sales velocity, ad rates, things like that, down to the ASIN level. And again, when we went out and bought our first cohort of deals, we were looking at the totality of a business.
Not individual ASINs, yeah.
Now,
Two hero products, that is the business, not all the other junk in their catalog.
exactly. And if I was buying a business now, I would literally be looking at every single ASIN as its own diligence, project. And now the data science exists where you literally can kind of figure out the net contribution margin and the health of a single ASIN based on its performance, especially if you can pull back historicals, that's where you start getting those massive cloud computing things, like pulling a year's worth of data and then analyzing that. So again, this is going to be really interesting to watch some of these aggregators. I know that, somebody with Thrasher just announced another massive, round of fundraising. They're certainly going to be going down this path, and some of the other aggregators we've talked to are definitely thinking this. They may have even gotten the idea from me because they've all called me at some point and said, "What do you think where this is going?" and all that.
Right. So we've talked about criteria to evaluate companies you buy, but there's also understanding, how do you look into the future and say, I can buy this company for X, but I see a clear path to 5X growth with either the catalog this company has or the manufacturing capabilities they have, albeit different types of products. How do you look at companies and evaluate going forward? Or rather, what would you tell a brand today that's thinking of selling? What would you tell them to do in order to help demonstrate the future? The future, not just, hey, we're going to forecast some made up numbers, but there is a path towards us becoming a much bigger company down the road.
Well, let's use the starting point. Let's assume it's $1 million revenue brand.
Okay.
Somebody who's $1 million is probably, they may be in e-commerce. They may have an e-commerce background, but again, remember all those FBAs I talked about meeting back in 2017. Most of them weren't even e-commerce people. They figured it out along the way. But generally, somebody who's $1 million probably doing their own everything by themselves. And to be successful on Amazon, I think you got to be good at least a half dozen things.
Yep.
Particularly, you're going to scale. So that's kind of like the self-awareness. If you can point out to an aggregator, here were my weak spots. I was not good at PPC, but I was good at cultivating reviews, or I was great at product design, and that kind of thing. But then the real obvious areas are going to be supply chain, of understanding, if I, at my current MOQs, this is my net contribution margin, but if I can expand the volume up to here are the breakpoints with my supplier, or another supplier, where you can tell that to somebody, they can build that into their financial model. That's a really good thing. You're basically giving somebody the blueprint to grow your business. And the other thing with $1 million business, they're probably not SKU optimized. They probably, the one of the first examples, like when I first started looking at these businesses, I found a compression sock business that came in a grand selection of two colors, black and blue. Okay. And I'm like, sports compression, you want all kinds of colors, but they just didn't have the working capital to do it. So if you're presenting plans like that of like, here's my product roadmap, and particularly easy layups like child SKUs, but even a parent SKU where you've done the data analysis already and said there's a pathway for this to be launched if it had this much working capital. Those are things that if you bring that to the party with the buyer, you're going to be pretty attractive.
Let's flip things around. I've also seen a lot of these companies that have decent size, 50, 60 SKUs. They've thrown a bunch of stuff at the wall. Some of it worked, but they didn't get rid of too much. And so they're still playing in 40 SKUs they shouldn't be in. And so having that discipline to be able to say, we need to trim back your catalog, take that capital and reapply it to other things. That's a difficult discussion to have with an owner founder who every one of those products was a baby that he or she launched.
Well, every founder thinks all their children are beautiful, and the reality is they're not. And if we go back to the algorithmic targeting, I think you're also going to see, this is something I've always posited, is that maybe you don't need to buy the business. Maybe you just want to buy the ASINs that you want. And so you got 100 ASINs. We only want these 7.
Yeah.
And we'll pay you. And we don't want your Seller Central account. We'll figure out how to migrate them into our Seller Central account, but we really don't care if you keep all this other stuff.
Yep.
You can have it.
That's truly an asset-based acquisition.
No, but the thing is, you can do it. You can do it. You can do it because of the data science available and the ASIN unit economics. You can do.
So let's talk about some of the things you're seeing with the investors out there today that have started heavily acquiring firms. There's the Thrasio, the great big performer, and then there's a whole bunch of other companies, many of whom have raised $150 million. They have a lot of capital they've got to put to work, and were put to work fairly quickly. Some of these teams have operating teams. Some of these teams are just investors. If you knew what you knew, if you take what you know now and you could apply it to your life back at 101 Commerce 3.5 years ago, what would you do differently?
Oh, that's a long conversation. So first off, the world's very different now. In the last 6 months, I've had 3 financial institutions basically come to me with a package and say, "Here's $150 million. You want to go do it again?"
Yep.
I haven't been on one of those yet. But those conversations didn't exist when I was doing it. Like I was probably the first person to raise institutional money. That wasn't like just a family office or something like that. It was, a legitimate Series A. In that, there may have been one, but I don't know of one. And so just starting with the way we finance the company, I would do it completely different. I think the profile of the investor I would have selected would be completely different. I think one of the things that Thrasio did right was they right out of the gate were able to find a debt partner, which for us, it was really hard to find a debt partner that would help us scale. And so we were a little too dependent on equity, to get off the ground. And now, I won't give you exact numbers, but now, let's say you raise $10, somebody will give you $40 of debt on top.
Yep.
Because the math is so well known by all these investors these days. Very, very different thing. But that was one of the key things right out of the gate was our financing options were not as good.
Okay. So let's talk about some of the things you're seeing different aggregators do today. You say, yep, that's the right kind of thing to be doing. You've got the money. That looks like a good move too. One of the things that I'm running into a lot is many of these aggregators are going to the same brokers to look at the same deals. And so there's this mad rush. Hey, I got to go to this channel to find the deals. And then I've got to put an LOI on the table very, very quickly. That model doesn't strike me as one that's going to last much longer, especially in light of what you talked about with some of the more sophisticated firms having data scientists who can go and find the deals before the brands know they're up for sale.
Yeah. So, and this kind of also goes back to the other question of what kinds of people are you seeing backing these things, and doing the aggregators. And there's probably a dozen that have either raised 9 figures or close to 9 figures that I can think of.
Yep.
Some of them are taking a very sophisticated, data-oriented approach, and others are taking more of a private equity approach that's just like, oh, we're doing a multiple arbitrage and we're just going to consolidate all these things. I don't think those are going to be successful, simply because as simple as it is to think about, I think what was so attractive to so many people jumping in FBA is, it's simple. One person can run a 7-figure business. At the end of the day, though, they're still not that simple. There's so many levers to pull. And when you start trying to put, dozens of brands together, and, even like one of the first nightmares we had at 101 was, we bought 8 companies right out of the gate. The next thing you know, we had 26 Seller Central accounts. selling into 31 countries. And all of a sudden you're like, holy crap, how do we run?
Uh-huh.
And, um, and so, then you really learn quickly in that year one of what kind of team you need to build. And so the aggregators I've talked to, half of them get the kind of team you need to build and half of them don't. And it's kind of shocking to me that there's so much money is being committed when people don't really understand the type of team and what I call platformization of a company you need to build on top of Amazon FBA to be able to run, 100 micro brands,
mm-hmm.
dozens of Seller Central accounts, and manage tens of thousands of SKUs. You're building when I say platformization, it's a made up verb or whatever, but it's a combination of people, processes, and software that are necessary. And they'll all get there because they're all going to, you'll get your ass kicked to the point where you'll be forced to put in people, processes, and software. But some of the aggregators have clearly listened and are getting ahead of that curve very early, even before they get going.
Let me ask you that you talked early on about these different tiers of brands, depending on how big they are. One of the interesting developments I'm seeing is there are a lot of 25, 30, $40 million a year brands, guys that are doing, they're clearing 12, 15, $20 million in profit a year. For them to sell, they're expensive. They're so expensive that even if you've raised $150 million, you can't afford to buy one of these companies. And so now you're looking at potentially having a different type of investor be interested in those types of firms, or something has to change. What would be your recommendation to some of these very large private label brands that have built big, sophisticated firms and are looking to exit? Where do they go looking to be able to participate in all this excitement?
Well, this is where the whole little ecosystem is starting to outgrow itself.
Yep.
I'll give you one of somebody I'm talking to right now who's going to do 45, 50 million. I don't know if I have to fully close the books on 2020, but let's say call between 45 and 50.
Sure.
Top line, and let's say between 15 and 20 on the bottom line. You can't go to a business broker to sell that business. You're talking for a business like that. And by the way, it's growth rate, and it also has a brand that probably deserves a full omni-channel opportunity as well. Yeah. There's only one way to go, and there's two ways to go. You find a strategic in that space who wants to go build $1 billion brand out of that, or you have to take private equity, growth or private equity that do that. And getting those kinds of deals is very different than what a standard business broker offers.
And now I'm stuck having to stay on board for 2 years.
Oh yeah.
Lots of stuff.
Yeah, but that's going to be, in this entrepreneur's case, he could get rich twice. He'll have life-changing wealth just on taking some money off the table. But then he could literally become a billionaire. By partnering with somebody that can build a team around them and provide all the additional, capital, both acquisition and working capital, whatever it is, expansion capital.
So let's go back to the brand itself. I am a brand. I'm looking to potentially one day sell my business. Given what you've seen as an investor and as somebody who's looked at far too many deals, what suggestions would you have to a mid-sized brand, someone who's doing 2 to 5 million in sales? How do you get yourself ready to do the right kind of exit?
Well, the most important thing is get your books in order. That's standard, and you'll hear every broker and consultant tell you that. You got to get your books in order, make it easy for people. Again, if it's a very sophisticated buyer, though, they're going to ignore all that. They'll figure out what your net contribution margin is down to a basin level, and they're not going to pay attention to your books anyway, because it won't matter to them. But for the average person going out and selling through a broker, the better packaging you have, the better you're going to market yourself. I mean, it's just standard salesmanship. The way you package up your private label product,
Yep.
You package up your business the same way.
Let me ask you, too many of these companies are all in on Amazon. These brands only sell on Amazon. You talked earlier about the omni-channel. Is there a play here for some of these brands before they sell, for them to actually get serious about expanding into other channels?
I would say probably 4 out of 5, if not 9 out of 10 brands that would be in the $2 to $5 million revenue range have probably already experimented with Shopify, Walmart, Etsy, wherever. And what you find is there's 2 types of brands, and they fall into, one of 2 camps. And the second camp is a very small cohort. The vast majority should just probably stay native to Amazon. There's a term, digital native. Well,
Yep.
There's an Amazon native brand that literally that should probably be their whole life is on Amazon. Certain brands, though, like the one I was referring to, absolutely have a multi-channel and omni-channel opportunity, and they should experiment with others. But again, when you start moving into omni-channel, your operating costs go up dramatically. And all of a sudden now you don't get Amazon's 250 million consumers, right there at your doorstep. You
Right.
go generate your own traffic.
Right.
You have to have your own ad platform because it's not built into the Amazon PPC thing, and customer service isn't built right into the same platform.
Yep.
You get the fulfillment, all that stuff. So you really do have to think, as a solopreneur or running a small business with a small team, you have to actually think, what can you actually do well? And if you're not good at, supply chain, and you're not good at internet marketing and, whatever, stay native to Amazon. Let somebody else take it off Amazon for you.
So I want to wrap up our conversation today by asking you, when you look at the types of investors who are out there today and the tools and the capital they have available to them, what recommendations do you have? If you could be the traffic cop that people listen to, sounds like some of them have heard you already. If you could be the traffic cop, where would you push more of these investors in certain directions?
First and foremost is to talk to people like you and I, and we're not the only ones. There's a lot of people who've run these businesses, but also have experience, with the way institutional investors think.
Mm-hmm. Yep.
I'm sad to say, James, there is some dumb money coming into this now because it's kind of a gold rush. And, as we were talking about before, yesterday, I talked to somebody who I was literally like, oh my God, please don't write a check. You will lose that money like so fast. You really need to stop and get educated. But again, most institutional investors really do their homework, and they talk to a lot of experts. They try and find operators before they write a check.
Richard, I want to thank you for joining us today on the BuyBox Experts podcast. To learn more about Richard and his firm, Incline Capital, please visit inclinecapital.net.
Thanks for listening to the BuyBox Experts podcast. Be sure to click subscribe, check us out on the web, and we'll see you next time.